Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically what we are doing, we are covering the Indian banking system. Got it? In the Indian banking system, these are the topics which we have covered so far, like generations of the banking sector development 2014 onwards, and now what we are discussing risk in the banking. Okay, so these are the topics which we are required to cover, and we have completed the above two. Okay, in the previous lecture, basically we had started the risk in the banking, and the particular risk which we had started is the infrastructure, and you can say capital, investment risk. Got it? And even in the previous lecture that we had seen how the business relates with the bank. Okay, that we had seen. And second, we had seen that why there is a risk in the banking. Got it? So that's all we had covered in the previous lecture. I hope that you have revised that particular lecture before you have come for this lecture. As many times I have told you, it is for your own benefit. Okay, so with this note, let's start this lecture. After finishing the capital and the infrastructure risk, now we have the risk of stock market volatility to retail exposures. Okay, so what do we mean by it? First of all, there is a word stock market here. So what is a stock market? This is first we should understand, then we could proceed. Okay, already in the lectures of the SEBI, I had told you about the stock market, but here I'm going to just give you a quick overview so that you can revise that particular memory which you had fed up on that time. All right, and thereafter you will be able to connect the things in a proper manner. Suppose this is a company. For stocks, basically you have to understand the shares. Okay, shares are also called as stocks. All right, and what to mean by it? Basically all these things are dependent on the capital. Remember, so many times I have told you, in the finance world, the capital does not mean by any city. Like New Delhi is the capital of India, Mumbai is the capital of Maharashtra. No. In the language of finance, capital basically signifies the non-monetary asset and the monetary assets. Okay, so in the terms of the stock market or the share market, what happens? Suppose this is an organization. This is an organization called the XYZ. Okay, the XYZ will have the initial capital. Okay, and what do we mean by the initial capital? Initial capital is the invested capital. Okay, like the capital which had been invested in the starting of the business by the owners of the XYZ. Got it? Thereafter, suppose if their initial capital is rupees 100 crores. Okay, now due to some reason, whether to expand the business or you can say put up some new things, they required 100 crores more. Okay, so there are two ways. The first way which we conclude here is the first way. The second way. First way is the capital, or you can say internal generated capital. Second is capital outsource. Got it? If we go by the first term, it's an internal generated capital. It means that the founders of the XYZ, by the means of the secondary capital, or you can say by the means of add-on capital, they themselves generated rupees 100 crores. Okay? So the value will become 200 crores and the XYZ could carry out its business as they want to. The second way is capital outsource. It means that the particular amount they must be divide it into equitable value. All right, and that particular amount we called as shares. Okay, so if we go by this particular definition, then rupees 100 crores is the total amount they required. Okay, so what they will do, they will divide it into the 10 shares or 10 stocks. Okay, each stock, or you can say one stock valued at rupees 10 crore. Okay, so it means that 100 crores is divided into the 10 shares on the 10 stocks, with each stock or shares valued at 10 crores. Okay, so they required 10 subscribers. Subscribers means the persons who will buy these shares. It means that if anyone buy the stock and the share of that particular organization is required to pay 10 crore. Okay, so that's how the shares or the stocks works. Okay, now we have seen that there is a buying and selling, or you can say there is a concept of buying and selling. Okay, and we had learned so many times that whenever there is a concept of buying and selling, there will be always a concept of the market, right? Because the market is you can say the platform where buying and selling is happened. All right, so the particular market in which you can buy and sell the shares or the stocks is the stock market. Okay, so that's how the stock market works. This is in particular picture which I had already told you in details during the previous lectures of the SEBI and all. Right now what I just tried to put it in front of you so that you could understand it better. Okay, so these are the things of the stock market. All right, now let's move forward. First of all, we have to take an overview of that particular risk of the stock market: volatility. The stock market seemingly runaway performance, characterized by high valuation and increased retail participation, poses a risk to the retail exposures. Factors such as the proliferation of demat accounts and high price to earnings ratios across sectors indicate this risk. Okay, so basically you can say what happens. Suppose if we talk about the banks. If we talk about the banks called the XYZ, suppose it's a bank. Okay, having the total value of rupees 100 crores. All right, after deducting all the reserve ratios, cash reserve ratio, statutory liquidity ratio, PSL, whatsoever, suppose 25 crores have been deducted. Remaining amount will be only 75 crores. Okay, after granting a loan, suppose 30 crores have been granted as a loan. Now how much amount is left? 45 crores have been left out. Got it? This amount the bank have. There are chances that whether this amount is a bank's own capital or you can say depository amount. Okay, both of the chances. If it's a depository account amount, it means that bank is liable to pay the interest to the depositor. If it's bank capital, then still bank is liable to earn something on it in order to sustain a business or to ensure the regular flow of income. All right. So these 45 crores is now holding by the bank. Now tell me, is there any benefit for the bank to hold this amount? No. Why? Because by holding it, there will be no income flow. Right? And as we had seen in the previous lecture, the bank are also the businesses. All right. They are also entitled and you can say aspire to earn the profits. Got it? That's why what the bank will do now, the bank will invest it into the shares and the securities. Shares and the securities in the stock market. And here comes the risk. Okay, because you can say in the lecture of the SEBI also we had seen that whenever any particular organization or the company launches the shares, they basically launches the proposals with it. Proposals contain the information about all the things, like what is the company's current valuation, how they are doing, okay, what are their aims and ambitions by these funds and all, how much they could pay. These kind of things are basically you can say added on the proposals. All right. So when the bank invested the money, after seeing these proposals, there is a risk. Why? Because there may be some chances that the demat accounts will be proliferation. Okay. And high price to earning ratios across sectors indicate this risk. It means that the share they bought by themselves or through the investment channels, by you can say using third party or by granting the special withdrawing rights to the customers. So many things are there. Okay. By using these things, the price they paid for buying the share is much higher than the earning they earning from it. Okay. That's the reason. Got it? Now, after taking the overview, now it's a time to move ahead of it. So here you can see the term is written down, which is known as the illusion of wealth. Illusion of wealth. The illusion word signifies a condition in which the something which is not in the reality, but it seems to be the reality. Okay, this is the illusion. The stock market's bullish performance can create an illusion of wealth among retail investors, leading to increased risk-taking behavior and exposure to the equities. This can result in the significant losses if the market experiences a correction. Okay, now remember one thing: bank by itself and through the customers. Okay, like most of the banks nowadays are offered the demat services. Okay, demat services is basically the you can say account to participate into the stock market. Okay, this is the demat services. So here are two perspectives: through the customer, by itself. Okay, so when the bank by itself invested the money, it is directly taking the risk. But when through the customer they infuse the money in the stock market, is an indirect interest or risk, you can say. For example, suppose this is the bank XYZ, this is the customer of it, all right, who is using the demat services. So bank generally provided the overdraft on the demat accounts. The overdrafts is some kind of loan. All right. And remember, whenever the bank provides a loan to someone, the bank takes the risk of being defaulted. All right. So similar thing happen with the overdraft also. Like the bank provided the overdraft to him. Okay, similar like him, there were so many you can say the other demat account holders. Similar things will be done for them also. Alright, it means that when the bank is providing the overdraft facility, it is creating its liability, or you can say the risk. What if the loan or the overdraft not come back to it? Is it able to repay the deposited amount to the depositors who had deposited their amount with them? So this kind of risk is associated with them. Alright, so suppose this person is get the overdraft. It means that this person get the additional amount, or you can say some kind of loan from the bank to invest into the stock market. There are two terms in the stock market. The one is the bull, second one is the bear. Okay, I'm not going to take you into the deeper form. I will tell you about it in the lecture of the Indian stock market. Right now, what I'm just trying to do, I'm just trying to create a picture for you so that you could understand it better. When we talk about the bull, basically we talk about the what? We talk about the market rise. Okay, when we talk about the bear, what we talk about? We talk about the market lower condition. When the stock's prices goes high, it's a bull. When the stock prices goes low, is a bear. All right. So what happened if you look at this picture carefully? Markets bullish performance can create an illusion of wealth among retail investors, leading to increased risk-taking behavior and overexposures to the equities. Okay. Now, what do you mean by it? Okay, suppose if the stock prices are going higher and higher, okay, so it means that the company and the organizations which launching these particular stocks are having the profits. Okay, when the company having the profit in the high amount, so their dividend will also be higher. All right, so it means that if the person buys a share of that particular organization, then the person become entitled to receive the high dividends. This is kind of illusion, you can say. All right, but there is another thing also. Suppose someone bought a share at ₹100. It is the bullish condition. It means that the share prices are going higher and higher and higher and higher. Okay, so when the price reached the market cap of ₹1,000, the following person sold out the share. Okay, in how much he bought? ₹100. How much he sold? ₹1,000. Total profit ₹900. Okay, that's the condition. Got it? So when the bullish condition is in the market, everyone start thinking that the prices of the stocks are going higher. It means that the companies are doing well. So if we bought the share, we will get the high dividends. Even if we sell it out later, we will get the high price and the high profit. Okay, but this is generally not true. Why? Because maybe the prices are not getting higher just because of the performance. There might be some other things. Okay, might be the company which is posing that they are earning the profit, maybe they are falsing. Okay, maybe the market price, or you can say the market performance, is expected to be the good, but due to some reasons it falls down. This is unpredictable. Okay, and when we talk about the retail investors, basically these are the customers, okay, who do not have the much amount to invest in the market, so they generally bought the shares in the low denomination but in a high quantity. You can say the shares are of the low denomination but in high quantity. Okay, that's the reason. And if anything happens in the negative way, this can result in a significant losses if the market experiences a correction. Alright, so that's how the illusion of wealth works. Indicators of the risk: increased demat accounts. Okay, the rise in the number of demat accounts which are used to hold the securities in the electronic form indicates growing retail participation in the stock market. This trend can amplify market volatility and increase the risk of a market downturn. Alright, like there are two ways. The first is the stock market, second is the bank. Okay, first let's understand the stock market. Okay, remember, whenever there is a demand is equal to the supply, it is a ideal condition or the condition of equilibrium. Okay, second is whenever there is a high demand and the low supply, it is a profitable condition. But when there is a low demand but the high supply, this is the loss condition. Similar things happen with the stock market. Okay, like demand, if you call out the demand, basically these are the shares. Okay, when the shares are in excess, all right, it means that the person who is participating in it get a much more diversification for this portfolio. Okay, but when the supply, it means that when the you can say participants are in excess, it means that not only the options get limited for buying the shares, because right now there are many buyers and the sellers are less. Okay, secondly, there will be a high infusion of money. This will generate a condition of high money circulation in the economy, which leads to the inflation. And secondly, due to the high infusion of money, there are the chances of the losses. Okay, so this is just about the stock market. I will explain you this in the detailed form while we were discussing the Indian stock market, because right now here I'm just trying to give you an overview of the things. Okay, but when we talk about the banks, so as I have told you, banks generally offer the demat services. Okay, or in order to attract the customers, more and more customers, they generally provided a overdraft facilities. Okay, so suppose if the bank is having 10,000 demat accounts, okay, and they are providing 10 overdraft, okay, or for example you can say rupees 100 overdraft on this particular account holders. So if you multiply it, you will find total value is 10 lakh. Okay, you will find total value is rupees 10 lakhs overdraft facility has been provided by the bank. But if this particular thing has been changed and now this become 40,000, it means now the bank is holding 40,000 demat accounts, and if the rupees 100 has been provided, it means that total 40 lakh rupees demat overdraft has been provided by the bank. Now you can just check it by yourself, like whether the amount has been increased or not. And if the amount has been increased, it means the risk also goes higher. Got it? So keep this thing in your mind. Thereafter, high PE ratios. Elevated PE ratios across sectors suggest that stock prices may be overvalued related to the earnings. This could indicate market exuberance and increase the likelihood of a market correction. Like basically here P is signifies the price to earning ratio. Okay, please keep the definition in your mind. The question may be asked you in the examination, like what do you mean by the PE? So PE is basically price to earning ratios. All right. So basically, if we talk about this particular thing which is written down over here, so PE signifies the price paid for share. Okay. First condition, or second condition is earnings generated from the share. Okay, there are two conditions. First, price paid for share. Second, earnings generated from the share. Got it? So suppose when we talk about the high price, okay, so generally it's a perception, and you can say it's a common behavior that the high price signifies the high returns. Okay, and you can call it high returns हो गया, high returns, and second one is high utility. Okay, generally it's a common thing. Got it? But what happened when you had paid rupees 10,000 for acquiring of share and your earning generated is only rupees 1,000? Okay, so in such a case, price you have paid and earning you have got. So what do you think? Was that worth to buy the share at that price? No, not even from a single angle it was worth. Okay, so that is signified by the price to earning ratio. Okay, like when this happens, it is advisor, or you can say it is supposed to rethink that whether the price of the share is you can say justified or not, or maybe the share was overvalued. Got it? So that's how this works. Integrated supervision. Regulators and the financial institutions should adopt integrated supervision frameworks to monitor and manage risk associated with retail exposures to the stock market. Okay, includes conducting regular assessment of market conditions, investor behavior, and the impact of the market volatility on the retail portfolios. Rigorous stress test. Banks should conduct a rigorous stress test on their retail portfolios to assess their reliance to potential market downturns. Okay, stress tests can help to identify vulnerabilities and guide risk management strategies to mitigate the potential losses, because before entering into the actual battlefield, you have just tested it. Okay, so this is the beneficial case. Diversification, if we talk about in the risk mitigation, retail investors should diversify their investment portfolios across asset classes to reduce the exposures to the stock market volatility. This can help mitigate the impact of a downturn in any particular sector or a market segment. Okay, so students, basically in this lecture we had just discussed some aspect of the risk of stock market volatility. Okay, in the next lecture we will continue from here. Diversification, I will explain you the diversification, like what do you mean by the diversification and how the system works. Till then, just make sure you revise the lecture which we have just discussed right now, so that you would be able to connect the points and the dots in the right direction. Okay, so with this note, let's end this lecture, and what we say thank you.